Hello once again, I'm Álvaro Vallejo and today we're going to be talking about the first few words for this video blog. The first word is going to be fixed income. Fixed income is the term used to refer to an investment vehicle that pays a pre-established coupon on a regular basis and has a set maturity date. When you invest through a fixed income instrument, you become a creditor of the company or government entity that issues the instrument. Throughout the life of a fixed income investment, the investor receives the coupon payments at a predetermined intervals and at maturity, and the investor will receive back the totality of the investment, also known as the principal. Fixed income investments are also more commonly known as bonds. They are popular instruments because when held to maturity, the investor is not subject to a market price fluctuation and he or she knows in advance the return that he or she will receive. The second term is stock. Stock is the term used to refer to an investment vehicle that grants the investor a partial ownership of the company. And in exchange for the investment, they have the right to participate in the earnings of the company. Each share of stock grants the owner a portion of the company's profits and dividends, as well as voting rights in shareholders' meetings, for example. A company issues stock as its primary means of raising capital. Stock subjects the owner to price fluctuations of the stock in the stock market, so the return is variable. There are several types of stock, but the two most common types are the common stock and the preferred stock. The preferred stock represents equity ownership in a corporation but does not have the same voting rights. The third term is securities. It's the term used to refer to all investment vehicles. Stocks and bonds are types of securities. It is the financial tool that represents an owner's position in a publicly traded corporation, known as stock, a creditor link with a governmental body or corporation, also known as bond, or rights to ownership as represented by an option. A security is a negotiable financial instrument that represents a financial value, and the entity that issues the security is also known as the issuer. The fourth term is blue chip stock, and it refers to the equity issues of financially stable and well-established companies that have a track record of paying dividends in both good and bad times. Examples of companies are considered blue chip stocks are, for example, Coca-Cola, sorry for the Pepsi lovers, or Procter & Gamble, that are blue chip stock, established and financially healthy company that has been operating for many years. A blue chip stock usually has a market capitalization in billions, also as a market leader, generally in the top of 3 companies of its sector. A blue chip stock generally represents the market indexes or averages. The fifth term is shareholder. Shareholder is a person, a company, or another institution that owns a share of a company. The shareholder is an owner of the company by itself. They can get benefits out of the company if the company is doing well, but can also lose if the company does poorly. They have rights, but personally don't have the obligations or debts that a company has. Also, the corporate shareholder do not play an important role running the company. But common shareholders can vote on important matters such as choosing who sits in the board of directors or whether or not a matter that is treated in the board of directors should go through. A shareholder can also benefit from the company and can exchange the share of a stock exchange making it a stock of a highly liquid investment. The shareholder can inspect books or movements of the company, and they also have the right to receive a part of any dividends that the company declares. There are three types of shareholders: common shareholders, preferred shareholders, and corporate shareholders. The sixth term is dividends. The dividends are a distribution of a portion of a company. The dividend is decided by the boards of directors, and usually the dividend is commonly decided in terms of dollar amount that each share receives. It can also be quoted depending on the current market's price, also known as dividend per share, DPS. A dividend can be in cash, in properties and stocks, and established companies give dividends to their shareholders. The share prices don't usually move much, but the dividend tries to make it up for that. The bigger companies rarely offer dividends because they reinvest their benefits to maintain the growth of the company. The seventh term is bonds, like James Bond, for example. Anyway, bonds is a debt investment where an investor loans money to an entity. The entity can be a corporate or governmental entity, borrowing the funds to a specific period of time at a fixed interest rate. Bonds are commonly known as fixed income securities and are one of the three main asset classes. The other two are stocks and cash equivalents. Bonds are used by companies, municipalities, states, and governments to finance a variety of projects. The eighth term is Treasury Bills. They are also known as T-bills. It is a bill issued by the government treasury from the US, United States of America. They are debt instruments used by the government to finance the governmental services or projects. When there is a deficit, the government sells the debt. So in reality, you are giving a loan to the government, buying the debt. The treasury bills have a life of a year or less, more or less, publicized in terms of 28 days, 91 days, or 128 days. And for example, when you buy a T-bill for $900, for example, the government pays you back. And when they pay you back, you will get $1,000, earning the difference, $100, like if it was an interest from that amount. The treasury bills are published every week and can be bought directly from the government, and they have been always seen as a safe investment. Well, this is all for today. Thank you very much, and bye-bye.